I'm Jasleen, everyone. I work at Nyca. I'm one of the investors on the investment team. Nyca is an early stage fintech fund. We invest across the full spectrum of fintech. Really, the idea and the name is really fun. It's New York, California. So it's taking the financial services from the East Coast, bridging it with the technology of Silicon Valley. And so that's how sort of Nyca came about. You had asked me more about myself. I almost launched into Nyca. I joined Nyca 2.5 years ago. I came from another fintech fund where I was investing on the growth side for about 3.5 to 4 years. And then I spent 5 years at JP Morgan before that, looking at all things enterprise software, internet marketplaces, digital internet and media companies. And that was for about 5 years. And then prior to that, I did a little bit of work in the accounting field. And then one of my first jobs ever was working at a startup really, really, really long time ago. I think over 10 years ago now. So, and that landscape was very different, very chaotic. Fundraising was not the same, and founders were a little bit more kooky. But I left that world because I wasn't getting paid and I had a student loan. And so I said, thank you for this opportunity and I will leave. That startup no longer exists. I started out in an early stage company, and then I came all the way to the other side where now I get to invest in early stage companies. So Nyca, as I mentioned, is an early stage fintech VC. So we'll typically play around the seed and Series A region, but oftentimes we'll even get involved on growth stage. And so we'll make a handful of Series B, C investments. And then sort of as a format of portfolio construction, we'll do a couple of late stage pre-IPO type investments. And that is 1 to 2 per fund, so not all that many. But yeah, that's sort of the early stage where we play. And when I say we do fintech only, I really do mean that. We are pretty thematic investors. And so everyone on the Nyca team usually picks some sort of silo or vertical that they're really either interested in, or if you're junior, you sort of get assigned. But we really go super, super deep into that vertical and try to understand who are the key players, what are the problems that they are experiencing, and what are maybe the solutions that they're seeking. Because I think one of the things that we find is you may think you need a solution, but in reality, maybe the fix is actually not as complicated as you think. And so a lot of companies end up providing solutions for problems that don't really exist or are not as big as we think they are. So I personally have verticalized into a couple different segments at Nyca. I cover all of wealth tech, which is pretty broadly defined. It also includes employer and employee benefits, traditional asset management. And as a part of it, we also do capital markets investing as well. And then my favorite, but other vertical that I lead is commerce enablement for omnichannel merchants. But we really try to have some sort of fintech angle to that as well.
Got it. So as you look at startups throughout the year, how many do you expect to look at versus how many do you expect to invest in?
This is hard. The funnel is so crappy, honestly. I mean, I must see like thousands a year because I talk to, I would say, I don't know if it's like a slow week, maybe I talk to like 6 or 7 companies a week. If it's a busy week, I'll talk to like maybe 10 to 15 companies a week. And you put that all together every single week. By the time we get down the funnel to how many we actually invest in, I would say maybe it's like 10 a year. And so really, when I mean that the funnel is shitty, the funnel is shitty. But yeah, and we'll also engage in diligence with a lot of these companies in the hopes that we'll actually get them all the way down to the bottom of the funnel. But oftentimes, we're very lucky at Nyca. We have this expert network that we've built. We call them LPAs, limited partner advisors. They're individuals who have spent decades inside of the financial services industry, either as operators, regulators, C-suite execs, and we pull them into our diligence process. And because we think that, like maybe I don't have this absolute niche expertise in this very tiny little space inside of capital markets that I've never spent any time in, but who does? the CIO of Citadel does. I work with him very, very closely. Maybe it's something in the commerce space, and I don't know something very specifically about this angle of fraud in payments in marketplaces, and so I work with the ex-global head of payments at Amazon. And they will help us dig a little deeper and find those nuances that maybe we wouldn't have caught. And then that's how, the diligence sort of eliminates some of the companies that we think might be great, but the experts sort of give us a little bit more insight. I'm a bit of a cynic, which I feel like some people don't like, because I feel like my whole job is taking risk and being an optimist. But when I started out investing, or at least I flipped into investing in 2018, the market was very, very different. A Series A was getting done, sub $30 million. A Series B, which is really where I played, it was, I could get something done under $50 million. And I'm talking about valuations. Now you can get a Series A at $100 million and no one bats an eye. So the market has really shifted, and there's a lot of reasons for that. A very quick and dirty view of why that sort of happened was in the pandemic, there was just this whole influx of capital, not only just in the pockets of consumers or individuals, also in the pockets of large enterprises and large financial institutions. Because of that, they were able to deploy a lot more capital into the sort of vehicle of venture and growth and private equity. And so all of those funds were able to raise a lot of money. Now, when you think about it, if you have a seed stage fund that has $1 billion to deploy, if they give you a $5 million check, it doesn't really move the needle for the $1 billion fund, right? Unless you somehow, I don't know, magically were OpenAI at that time. So what happened was that funds were deploying a lot more capital into companies. And because of the appropriate dilution, the valuations got a massive uptick. So if I'm going to give you $20 million, I can't really value you at $50 million, right? I would have bought a lot of your company. And so all of a sudden, your company, now that I've given you $20 million, has to be worth $100 million just to make sure that that dilution works. So lots of valuations came extremely high. Lots of bigger funds started deploying early stage. They had no business doing that, mostly because they also didn't understand the early stage market. And so now what's happening is that those funds have realized that they've had to write off a lot of those companies. And they've realized that they needed to move later stage again because they don't actually know what they're doing. And so the capital now deployed at early stage is coming down again. And so now, if you're a founder in the room, you'll have realized that when you've gone out to raise, it's not so easy anymore. There's not so many funds deploying anymore. They're giving you less cash, and they are also asking, hey, what about profitability? So we're coming back to a time where legitimate questions are really coming into play again, which is what we lost a while ago. And I think the future is just more of that. And I'm quite excited for it because it benefits me as an investor, and it also is going to insert so much more discipline back into the ecosystem where founders are not heavily relying on the next round of funding and free money coming their way. So it will hopefully spawn a new era of incredible companies. I think Airbnb was founded during the downturn, and so look what came of that company. Uber was the same. So I'm sure there's a whole class of new startups that will come out of this time. So, I mean, you guys probably all know this already, but the market is completely saturated with companies that are just replicas of things that already exist. And so standing out really is a couple different things. So if you have a unique product, something that really is going to resonate with customers, that is an incredible selling point, right? If there's a pain point that remains completely unsolved, then that is something that's going to be unique. Now, let's say you don't have those things, right? And you have sort of a copycat idea, or you're a rapper of something or something else. The real way to differentiate yourself is go to market. Now, you could have an incredible product, but if you have no way to sell it, it doesn't matter. right? The product is just going to stay in your garage and on your computer with you. So, and that's not really going to make for a successful company, a successful founder, or a successful investor. So, if you think that you have something that is very differentiated today in go to market, which is very hard to do, then you probably will be one of the most successful companies around. And I'm interested in really finding that. So it's one of the questions that I always ask a founder right after team, product, and then go to market. Why should anyone buy this product from you? And also, of course, the real important thing is team. At such early stage when you're investing, coming from growth investing, which was really about the numbers, because you're a proven team. The product market fit is already there. How are you going to scale? And can we see that in the numbers? But with early stage investing, the team is just so important. So I really spent time on that as well. They're tied together. Best way to get in touch with me and probably any VC is to get a warm intro, right? If I have an intro coming in from a portfolio company founder or a friend or someone that I know in the ecosystem, 9 times out of 10, I'm going to talk to you, unless what you're building is just completely, out of left field in terms of what I'm investing in. So I think the best way for a founder to get an intro to a certain VC that they've identified is relevant for them is go on LinkedIn, scour through the people that work at the fund. You most definitely have a connection to that individual through a mutual. Dig, and work hard to get that intro, because then the VC will definitely talk to you, right? Cold inbounds, if I'm being completely candid, rarely work. We at Nyca get, I don't even know how many a week. My personal inbox, it's like tens of emails, if not, yeah, like let's say like I get like 10 to 15 a week. Most of them, this is actually just my inbox. I'm not talking about my spam box. My spam box, I check every like 3 months and it's just like, I don't even know. And I hit select all and I hit delete and I never look at it. So cold inbounds are not going to work. They may for some funds, especially the ones that have a lot of junior resources that can parse through and just quickly talk to you. But a lot of us obviously are meeting with a lot of portfolio companies during the week, new companies during the week. And so find a way that's unique and through an angle that feels like a warm intro, because then you will definitely be able to get to me. Otherwise, reach out to me on LinkedIn. I've definitely met founders through LinkedIn. There was one in particular that I really wanted to invest in and I just didn't get to. Someone else preempted them and that was that. So,
do you only lead?
No, so we lead, co-lead, and participate in rounds. There's no real prerequisite for us to get involved in terms of metrics or numbers, and I know that I talked about it, but truly I mean that. What we really target at Nyca is ownership. So we genuinely believe, and we know from our other portfolio companies, that we have certain value add to you. And if we feel like we have no value add, we likely won't invest. But we will target ownership thresholds so that we know that we are also being compensated for our time that we are dedicating to you. I definitely play therapist to a handful of founders in my portfolio. They know that they can call me quite literally at any time of day, and they do.